Hey Bowtie Nation, Joseph Hogue here with your weekly market update, 9 a.m. Eastern every Monday morning with the stocks to watch and a very important update video for investors in MPW, NYCB, SoFi, WW International, and Chargepoint Holdings. The stock market is nearing its all-time high, and we've had some great stocks since the end of the bear market. Shares of DraftKings were up 230% since recommending them from early last year, and more recently, SoundHound AI jumped 7% on its earnings and is now up 35% since following it in February. But there's also been some not-so-great stocks that just haven't played out like I thought they would. I think we need more accountability here on YouTube and across social media, so to that end, I want to revisit those 5 stocks: Medical Properties Trust, New York Community Bancorp, SoFi Technologies, WW, and CHPT, why these stocks have struggled, a forecast for going forward, and which ones I'm double dipping to buy more. Stick around and we'll do our weekly stock market update with the stocks to watch this week and the economic news you need to see. First though, if you're going to be investing in individual stocks, you need some cash set aside in safer investments as well. With the rate on I-bonds crashing lower, I've switched my bond money to Worthy Bonds, a fixed income platform with bonds backed by small business and short-term real estate loans that pays 7% interest. You can invest as little as $10 per bond and earn interest on a daily basis. Best of all, you can withdraw all or some of your money anytime with no fees and no penalties. Worthy even has a roundup feature that lets you invest your spare change on purchases into bonds, automatically building your portfolio. You can even gift bonds to someone with just their email address. I'll leave a link below to more information. Use the link and you're going to get an exclusive deal I worked out for everyone in the Bowtie Nation. Buy 5 bonds and get 1 free. Invest just $50 and get $10 free. That's a 20% return on top of the 7% interest rate. So look for the link below or just scan the QR code here. Back to our main topic though, and from tracking my portfolio on StockCard years ago to sharing it now on Blossom, I'm proud that the stocks I've highlighted on the channel have on average beaten the market over the last 6 years. That doesn't mean there haven't been some spectacular failures in individual stocks or others though that continue to fall, even though I think they'll ultimately produce strong returns. And for that, I'll be the first to admit, when it comes to investing, being early is just as bad as being wrong. I can't stand when the perma-bears like Ray Dalio and Michael Burry go on CNBC to scream their perpetual chorus that the market is gonna crash, only to crow about it when they're eventually right, when the stock market does crash years later. I think it's deceitful when they do it, and I'm not going to be beaming that I was right when investors had to sit through years plus of a crap stock before it proved my valuation thesis. So I wanted to take this opportunity to revisit some of the stocks that I've covered on the channel, all that I've bought myself that have failed to live up to expectations. As we should always do with any stock, I want to revisit the bull and bear case for the stock, evaluate why I was wrong, and decide whether a catalyst for a turnaround is near, or if the stock is going to continue to be dead money. First though, the lesson, as it always is, to not have all your money in one or a few stocks. Now, I know Warren Buffett has nearly 40% of his Berkshire portfolio in just shares of Apple, and 73% of the portfolio in just 5 stocks. You're not Warren Buffett. I'm not Warren Buffett. We don't have an army of analysts doing research. We don't have that insurance stream of cash flow to invest. As sure as you are about any stock, it can always fail that confidence, and you don't want your livelihood depending on that. So please just remember, no more than 5 or 10% of your total portfolio in just one stock. First up here is one of my favorite forever stocks, even though the roller coaster ride up and down has put me back on heart medication: SoFi Technologies, ticker SOFI. I started recommending SoFi and buying in May 2022 at around $5.15 a share and have built a position of 34,000 shares. Some of those have been bought at higher prices, around $6 to $6.50, so the cost basis is a little bit higher. But I have also been aggressively selling those call options against the stock whenever it reached around $10 a share. It's meant collecting over $48,000 cash over the last 2 years and lowered my actual cost basis down to around $5.50 a share. I talked about how to set up that covered call option strategy in Friday's video, a great strategy for lowering your risk on a stock, especially after a big run and collecting that cash flow. So I'm going to link to that in the video description below. You're going to see in this video, it's one of my favorite strategies. I've used it on nearly every stock here. I started buying SoFi after it bought its banking charter in a merger with Golden Pacific, a move that gave it a competitive advantage over other fintechs. Now, that banking charter opened it up to collecting deposits, a cheap source of funding for loans that other fintechs just don't have, and I saw SoFi growing into a major bank with the ability to offer products combined with those advantages in an online banking costs. Investors are still hesitant, though, about those non-traditional fintech stocks, and and it's struggled whenever growth stocks have sold off. Despite the weakness this year, the most recent quarter reaffirmed my outlook here. We did see slower revenue growth, up 26% from a year ago, but it was the first period to see quarter-on-quarter declines. Still, member accounts continue to grow at a 44% annual pace, now over 8 million, and the bank was one of the few to increase its deposits through last year's banking crisis. Management expects to post its first net income profit this year and add up to $1 billion in tangible book value. On my forecast of 2024 ending book value around $6.15 a share, the stock is back to around 1.15 on a price-to-book basis, which is very attractive for a bank. Again, that's the valuation metric you want to use for banks, is that price-to-book value per share. Now, I think the shares make it back to $10 sometime this year or next. But that said, selling call options against it when it runs high has worked very well for me, and I'll probably continue to do that. WW International, ticker WW, the old Weight Watchers, has been one of the most disappointing stocks in my portfolio, but it also has one of the most potentials on any good news. I started buying WW in February 2022, around $9 a share, but got more aggressive adding shares when it fell into that $3 to $4 range. Like with SoFi, I sold calls against the 25,000 share position last year when the stock surged past $10 on the news that it would acquire clinic drug provider Sequence, so my cost basis here is closer to about $3.60 a share, but still well off that $2 current stock price. Now, the original thinking here was after a big drop in the shares on subscriber losses, that WW still had a strong brand, endorsements from major celebrities, and that continuous demand for weight loss programs that would bring it back. And then all three of those reasons fell apart. First, of course, somebody had to go and invent those GLP-1 drugs, which hit weight loss programs like an anvil. More recently, Oprah has donated her shares and left the board of directors. Now, she's still supporting the company with multiple specials on TV and YouTube talking about her experience with GLP-1 drugs and the WW program, but it took the floor out from under the stock when she announced her departure in March. That negative sentiment, though, is at an extreme, with 21% of the shares shorted. The clinic program, which is prescribing weight loss drugs, has outperformed expectations, growing to 87,000 subscribers and is expected to hit 160,000 subs by the end of this year. It's a higher margin product and really locks people in with that need to stay on those GLP-1 drugs for life. You gotta take that weekly shot for the rest of your life on these things. Overall subscribers stabilized in the most recent quarter at about 4 million subscribers, with expectations to end the year at right around 3.9 million, and for revenue to come in slightly lower at $850 million. Now, with any troubled stock, especially any of these five recovering today, cash and cash flow is always the big worry, and it's here that I feel more confident with WW. The company does owe over $1.5 billion in debt, but has $66 million in balance sheet cash, enough to cover the cash outflows in its operations right now, and no debt is due until 2028, which gives the company plenty of time to grow that clinic segment and its revenue. On that, I think the stock is undervalued at just $157 million market cap against almost $900 million in annual revenues and that booming clinic business. The growth and higher profitability in the clinic subscribers is likely to drive positive earnings next year that is going to take a lot of risk out of these shares for investors. At that point, the stock should re-rate to a higher valuation and get to my target between $3.50 to $4 a share. Now, this wouldn't be a forever stock for me like that SoFi because it would be more volatile as we get closer to the 2028 debt maturities, but for now, it's in deep value territory. Chargepoint Holdings, ticker CHPT, could have just gotten the news that sends it higher and is right now one of the largest positions in my portfolio. I started buying here in September 2023, around $5.80 a share, and got aggressive adding more at $3 a share. I've got a total of 107,000 shares across 3 accounts, but I've sold calls against it each time, adding more, so my cost basis here is just over $2.18 a share. And with charging, it has been crazy how the environment has changed against this. Just a year ago, electric vehicles were the big trend, and charging was the big bottleneck in EV adoption. EV volumes were growing by 50% a year, and the government has signed a multi-billion-dollar infrastructure bill that would subsidize companies setting up charging. So I thought Chargepoint, ticker CHPT there, the leader in stations across US and Europe, was very cheap and a no-brainer investment. Then 2024 happened. A price war in electric vehicles has slowed production plans for a lot of makers, and a political backlash has made it an election issue. EV volume still grew 25% to the end of last year, which is still solid growth, but it hasn't been all big picture problems either that have hit the stock. Management seriously dropped the ball here, with the board sacking the CEO and CFO in November of last year. We're still a couple of weeks from the company's earnings report at the end of this month, and competitor EVgo reported a disappointing quarter last week, so we could see more big-picture weakness on Chargepoint when it does report, but the company could have gotten some surprisingly good news late last month when Elon Musk fired almost his entire supercharger team. Those layoffs shocked the market because Tesla had built itself up to lead charging, even creating the industry standard. Musk backtracked some last week, saying the company would still invest $500 million in new charging stations, but it's unclear how Tesla is going to do that without anyone working on the segment. Project partners have reported bounced emails from their Tesla supercharger contracts since the layoffs. What I'm thinking here is ChargePoint and those other EV charging companies now have a big opportunity to step in and fill that gap in infrastructure, reporting higher than expected revenue to come. Subscription revenue jumped 41% last year and is now 24% of total revenue. That subscription revenue is very important and extremely sticky because customers would have to change out expensive equipment to change their providers. Management expects that recurring revenue stream to keep growing and eventually become nearly half of total revenue, helping the company get to EBITDA profitability towards the end of this year. ChargePoint is another one with no debt maturities until 2028, giving it lots of time to improve its profitability and grow revenue. I started buying shares of New York Community Bancorp, ticker NYCB, in 2021, around $12 a share, and have been picking up more in February and March of this year, around $4 a share. With dividends over the last 4 years, my cost basis here is about $7.10 each, but this one has a lot of way to go yet. And the problem here is, along with the hit to community banks over the past couple of years, NYCB has also suffered from its loan portfolio to multifamily properties in New York City. Of the $86 billion in loans on its balance sheet, about $44 billion is multifamily, and much of that in the city, in New York City, and that's been a major problem since 2019, when the state government seriously restricted landlords' ability to increase rents. Rent-controlled apartments are as much as half of the city's multifamily supply, and it's created a crisis over the last year. The bank did get a lifeline earlier this year with a $1 billion capital injection by a group led by Steve Mnuchin. It took the edge off, and the stock jumped 30% on its most recent earnings when CEO Auding said that the company sees a path to profitability within the next 2 years. Shares have a tangible book value of $9.07 a share, meaning the stock trades for just 0.38 times its book value, making it the cheapest among large U.S. lenders, according to S&P Global Research. We know Mnuchin and his team got a full look at the financials, and that billion-dollar vote of confidence goes a long way here. The shares are terrifically cheap on a price-to-book basis. For reference, most banks trade for between 0.8 to 1.2 times book value, so this would be half again as cheap as the least expensive bank stocks. That said, unless New York City does ease its rent control laws, the multifamily crisis is only going to get worse. NYCB may be a good rebound opportunity back to $5 or $6 a share as it comes off that fire sale valuation, but I would be looking to exit the position at that point, so not making this a long-term investment. And Medical Properties Trust, ticker MPW, is our most requested update video on the channel, and just got some good news that investors thought was bad. I started buying shares of MPW late 2022 at $10 a share and got more aggressive adding more when it fell to about $5 to $6 a share. I collected dividends on that 9,000 shares since, so it's helped offset some of the cost, with the cost basis around $5.80 a share. And here, MPW is the largest owner of hospital real estate in the United States, with 436 properties in 31 states and across Europe, worth $17.4 billion. With the trend to higher medical spending and the safety of real estate, I liked that 12% dividend yield I was getting when I first started buying the stock. Then here, the Fed started raising interest rates at the fastest pace in 40 years, crushing the entire real estate sector. Real estate investment trusts, those REITs, plunged 25% in 2022 and are up just 4.7% over the last 5 years, by far the worst performing sector. A labor shortage for nurses and other healthcare professionals have driven up costs for hospitals, and government medical reimbursement rates just have not kept up with inflation. All this has meant a crisis in profitability for hospital operations, and MPW management has continued to bail out its two largest tenants, Steward and Prospect Medical, with loans rather than making them sell their hospital operations to better run companies. But what most investors thought was bad news for MPW could actually be the light at the end of the tunnel. Its largest tenant, Steward, there, filed bankruptcy last year and is going to auction off its 31 hospitals to new operators within the next few months. MPW provided a $75 million bridge loan to keep the hospitals open, which is going to help bring in those new owners. And if we look at this $9 billion in debt, Steward reported 2/3 of that, $6.6 billion, is future rent obligations, mostly to MPW. With $6 billion in annual revenue from those properties, Steward should be able to collect enough from those auctions to significantly pay off the loans owed to MPW, all the while putting tenants in those properties that can pay the bills. And while investors initially sold off shares of Medical Properties Trust on that knee-jerk reaction, the stock is up 13% since the bankruptcy announcement, as the market realizes that this puts MPW on a much better financial footing, finally ripping off the Band-Aid on that bad tenant. Any return to normalcy here could see a big upside to the shares. Funds from operations are expected to reach $1.25 per share this year, which puts the stock at just 3.3 times on that price to FFO basis. That is a 72% discount to the 12.3 times FFO average across healthcare REITs. Now, of course, those worries around Medical Properties Trust do not evaporate overnight, but this stock should be trading at least 5 to 6 times FFO once it clears up those existential problems. That could put the shares between $7.24 to $8.69 within the next year. Turning it over to the stocks I'm watching this week, Alibaba Group, ticker BABA, is going to be reporting its earnings on Tuesday, with the stock up 16% in less than a month on that potential for upside. Even after the bump, the shares are still attractive here on a valuation of just 9.3 times its price to earnings and 1.5 times price to sales, versus 42x PE and 3.2 times price to sales for pure Amazon. Of course, Chinese stocks always trade at a valuation discount to the US peers, but there is significant value locked away here, especially in AI. The company updated its Quinn model recently, its 2.5 version, and reported improvement that could rival OpenAI and other top models. Beyond AI, we're seeing green shoots in the Chinese economy, and institutional investors are finally returning to those shares. Walmart, ticker WMT, is going to give us a clue into the health of consumers when it reports earnings on Thursday. The retailer has benefited during periods of these consumer pullbacks on its ability to keep customers coming in for those groceries and their other necessities. Longer term, Walmart's majority-owned fintech, One, is now entering the buy now, pay later space, which could help drive revenue with millennials and Gen Z. I'll be watching what management says during its earnings call, not just for the shares, but as the company also gives us clues into the consumer spending for the rest of the year. SoundHound AI, ticker SOUN, was up as much as 25% Friday before closing 7% higher on the day after the voice AI leader reported revenue up 73% from the same quarter last year to $11.6 million. Better still, customer subscriptions and backlogs grew 80% to $682 million in the quarter, showing that estimates for $70 million revenue this year, growth of 51%, are beatable. While the company is still unprofitable and had $25.7 million in cash outflow through the quarter, balance sheet cash of $226 million is more than enough to cover those funds of operations as that revenue grows. It's still a very volatile stock here, though surging past $10 a share in March before plunging back down to a low of $3.50 last month. But the results here and the stock reaction show that this one can survive any AI bubble hype and produce that long-term wealth for investors. Full disclosure here, I do own 6,000 shares across accounts and wish I had more. Showing you the bigger picture view here with the SectorSpiders.com sector tracker. All 11 stock sectors closed higher last week, though without leadership from the sectors you would normally expect. Normally, in a strong market rebound, the riskier sectors like technology, communication services, and consumer discretionary outperform as bullish investors push more money into those growth names. Last week, though, is more typically the safety sectors like utilities, financials, and consumer staples that outperformed. That change in market leadership, though, is good news for market breadth, so i.e. more stocks rising. That shows more robust investor enthusiasm, but it also means that investors may need to look outside the Magnificent Seven and those tech stocks for the best returns for the rest of the year. What I thought was also interesting here is that stocks in the consumer discretionary sector did so poorly last week, up just 0.11% against more than half the sectors posting 2% return or better. It points to a developing weakness we're seeing on the part of the consumer, and the sector is likely to suffer further through at least the next several months. Stocks in the group are already down 0.4% for the year, one of the only two sectors in the red. I would watch for this week's retail sales report on Wednesday and Thursday's earnings report by Walmart for more clues into the health of consumer, but risk-averse investors may consider hedging some of their consumer stocks with options or taking some profits near term. All three major indexes did close higher last week as corporate earnings really prove that even signs of a slowing economy are not enough to derail this bull market. With nearly all 92% of the companies in the S&P 500 reported, earnings have been very good. More than two-thirds, 78% of companies beat their earnings expectations, with an index average of about 5.4% growth in earnings over the last year. That's the highest since the second quarter of 2022. Analysts expect profits to pick up with 9.3% growth in the second quarter here, is when it's reported in a couple of months. With that kind of earnings growth expected to continue all year, stocks do not look expensive here, and even higher rates for longer shouldn't slow the market's upside. Don't miss that exclusive offer and get your free bond on Worthy. Invest for 5 bonds and get 1 free with the link below in the video description. Or click on the video to the right for 9 of the forever stocks I'm buying for the next 30 years. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.